Hey everybody, Marty Missouri, good morning. It's the 20th of March, 2019. I want to share with you the charts, comment on yesterday and today's action, and just kind of help you put it all into perspective. So we're looking pretty good yesterday. This big bar here was really moving ahead of what had been really stiff resistance with some momentum. Looked good. I liked the volume. I liked the breadth. It was just a good looking rally. And as I said earlier, I really didn't see much resistance for quite a bit further here on the S&P 500, maybe 28, 74, 75 or so. I was surprised when we got the news that China seems to be walking back some of their previous agreements on intellectual property. As I wrote last night, found out later that China is reacting to the US's resistance to removing the new tariffs that have been added during the present administration. I've written a few times on the blog that such a deal I don't think is bullish for the market. I think that would probably be a sell the news event, meaning a deal that does not remove the newest round of tariffs. So that seems to be what the US is opting for, and it was resoundingly confirmed this morning by the president. Speaking to the press, the question was asked, and he said that tariffs could stay on for a long time. He wanted to apparently use them against China if indeed they renege on their side of the agreement. I guess one could argue that you could remove the tariffs and then add them back if indeed they renege. So this desire to leave the existing tariffs there isn't going to set well with the market, and it didn't this morning. The Dow careened lower on that news. In fact, let me show it to you on my 1 minute chart. This was that news. This is when the president made that comment here. Market's trying to struggle its way back. This is still down a bunch on the day on the S&P. In about a half hour, we're going to get the Fed. The Fed is going to try its best to be dovish. Dovishness is priced in. What I mean by dovishness is they're going to sound very accommodative when it comes to policy. Keep interest rates low, stop unwinding the balance sheet at some point in the not too distant future, and so forth. And I think the market could rally on confirmation of that. This morning's news on trade is probably going to mute whatever rally, of course. I'm just speculating on probabilities right now on a very short-term basis. But there is room for the market to bounce, although I think that if the trade news of yesterday and today continues along that vein, the market has kind of a tough time ahead of it. Underlying it all, for you clients out there, when we look at our long-term allocations, general conditions are still relatively fine. Weaker than they were at the beginning of 2018, but actually better than they were, say, a month ago. And I'm noticing on the international front some real improvements, particularly in Europe. So it looks like the global economy can weather the rough patch that it's been in and resume its march higher, which is essential for the continuation of the present bull market that we are still in at this point. A protracted trade war will kill it, in my view, quite frankly. I think that will precipitate the next global recession, and we will have to be getting defensive in your portfolios. A trade deal that does not include an elimination of the new tariffs over the last year or so, I think will not be enough to bring on the next global recession amid easing central banks and relatively accommodative fiscal policy the world over. A lot of elections this year, so the powers that be are trying to stimulate their economies in an effort to retain their political positions and all that good stuff. But unfortunately, it will be a continued headwind, and I think will make it difficult for this market to move in the fashion that it should if we were to eliminate tariffs, become friendlier with trade with the rest of the world and so forth. So trade's a big deal, make no mistake. So right now, everything remains to be seen, as I just said in the written blog. The reaction that I just showed you today, actually, we have to view that as constructive because it does seem to get the powers that be attention on trade issues, and it does seem to guide the conversation. So folks, again, right now, as we sit here today, we're not running for the fences, and I'm not giving a big dire recession / bear market warning. I'm just helping you put into perspective why suddenly a week that really should have been a good week that was looking that way, at least in the first half, may end up being a downer when it's all said and done. Of course, the Fed today could influence that in one direction or the other. But again, we're just talking short-term stuff. We'll continue to keep our long-term perspective, invest accordingly, and keep you posted on the details. Thank you, as always, for watching and listening. Talk to you again very soon.